Today's video about the new changes on investment and home loan lending in 2019. I'm going to take you through 4 key points, yes I have my cheat sheet, on making sure that you're getting more suitable home loans, the ability to look at different options and also affordability, but more importantly getting your loans set up right for the opportunity to look at proposed investment lending going forward in 2019. I'm Neil Carstairs from Mortgage Corp, your property investment mortgage specialist. There's been a lot of scrutiny in 2019 on affordability. The Royal Commission looking into banking misconduct and so forth, which has highlighted quite a few little bits and pieces. But when it comes to the mortgage side, it's really important that we go over these 4 key points and you understand the changes going on into 2019. Now, one of the most important things we need to look at is obviously getting rates. So we all look at interest rates. The rates are going to vary in 2019 based on a lot of different factors. Most importantly, whether it's principal and interest only, whether it's owner-occupied property or a residential investment. Obviously, I'm trying to keep my writing small, so we've got plenty of room, but on top of whether it's interest only, owner-occupied, principal and interest owner-occupied, investment lending, investment lending, interest only, there's a whole lot of other variables that come into play. And one of those variables are what we call LVRs. So whether your loan is greater than 80%, greater than 70%, less than 80%, greater than 70%, there are all these different LVR restrictions that are coming into play. Getting a more suitable home loan is where a bank is looking at it on a risk basis. So whether you've got plenty of equity, then you're going to more than likely not so much about the loan size, but more to do with the loan risk. So obviously having a loan at 80% or less is more than likely going to get you a very suitable product. Don't take that as you're not going to get the best deal, because we don't use that word. It is the most suitable, because obviously some of our clients who are borrowing above 90% are getting really ripper rates as well. Secondly, we're looking at maximising your structure and making sure that you're doing the right thing with your money. So when it comes to structure, we had a client recently who had savings in a bank account, about $50,000 in a bank account. They also had a mortgage with an offset account. This was actually in their offset account. We were able to show the client by reducing their owner-occupied and then borrowing more on their investment property, and how we structured that was the key. They were able to present that to their accountant, who was then able to advise them on getting better tax strategies going forward. We're really happy to work with your accountant, but making sure you get your loan structure right can be the key at the very initial, before you've even bought the property. So getting a good strategy in place with your savings and with other debts is the key. Number 3, capacity. What we're seeing at the moment is that different lenders are assessing loans differently based on assessment rates, living expenses, and a whole bundle of things when it comes to gearing and rent, and some are using 75% of rental income, some are using 80%. We've actually shown clients that by borrowing money from one bank, structuring themselves right, and then taking the investment lending to another lender has increased the capacity quite significantly. And I'm talking within $50,000 to $100,000, and that can be a big difference when looking at investment property. In the capacity section, making sure that looking at salary sacrificing, whether you're in essential services, if you're in the police force, a nurse, a doctor, a teacher, we can look at salary sacrificing differently. We don't have to use the post-tax deductions. We can use that we can actually use your pre-tax and post-tax deductions to increase your capacity to borrow. So there's a lot of little tricky things going into 2019 when it comes to capacity. And finally, number 4, believe it or not, is our favourite thing at the moment, living expenses. Living expenses are under more scrutiny now than ever before. If you really want to know what your month-to-month living expenses are, go to mortgagecorp.com.au, click on resources, and then go to expense declaration. We've got a fantastic calculator that helps break down your day-to-day, month-to-month year-to-year living expenses. A lot of things people don't think about when going for a loan is when it comes to living expenses are things like rates, utilities, gas, insurances, life insurances, income protection, car insurances, school fees. All of these will get looked at with a lot more scrutiny going into 2019. We're even sitting down with our clients 3 to 6 months before we even apply for a loan to make sure they've tidied up some of their credit facilities. They've tightened up some of their spending. No more Uber Eats on a Wednesday and a Friday, maybe sticking it to a Saturday afternoon. So these 4 things are really going to be under scrutiny in 2019. Interest rates in the right structure, the right type of loan will get you a more suitable product. Getting the right structure when it comes to investment planning at the start, so important that making sure that you get your loans set up right so you can present those to your accountant who can give you more strategy advice and tax. Capacity to borrow, really important to understand that some lenders will assess your incomes differently and structures differently, depending on whether you have lending with other lenders, whether you're looking at investment lending, rental income and so forth. And then coming back to living expenses, really want you to sit down and look at your living expenses going into 2019. All those little things you don't think of. Go to mortgagecorp.com.au, check out our living expenses calculator. It's up there with the best of them, and it really does help you out going forward. Obviously, the most important thing is recapping all of this stuff on a monthly basis, on a yearly basis, and it's making sure you understand, because a mortgage is your biggest debt. And if you can understand that getting the right structure, increasing your capacity, or making sure that you've got affordability in that, and that you're on top of your living expenses, can make your life a lot easier when it goes for a mortgage. Now, here's a question for you. If you haven't done your living expenses, again, go to mortgagecorp.com.au, go to resources, then expenses declaration, have a play with that calculator, and it'll probably give you a reality check. What we're seeing is a lot of people who've done their living expenses coming back to us with their 90 days bank statements going, actually, I really was out on this one. If you've got a question or you want to give us a message, contact us on 1300 138 943 or go to mortgagecorp.com.au and click on a link for a free strategy session, and more than likely I'll give you a call. I'm Neil Carstairs from Mortgage Corp, your mortgage investment property specialist.